All right, guys, Disney beat on earnings and revenue. They reported 99 cents per share, beating estimates of 75 cents, and they beat on revenue, $23.5 billion in revenue, beat by $100 million to $23.4 billion. Guys, this is our first video recorded in our new studio. They surprised me. I didn't know this was happening. Well, I knew the studio was happening, but I didn't know it was going to be ready. If you're new watching the channel, we do earnings releases every week that there's good, solid earnings. This has been a busy season. You got to know, though, we don't focus on earnings for our long-term goals, but we want to keep aware and see what the company says in their earnings calls that might disclose some future problems. Remember, there are cycles in the economy. We've had a good 12 or 14-year run, and expect earnings to decrease. There's already expected earnings for decreasing. Now, granted, that's earnings growth. I don't know how they did relative to last year, but this is the Walt Disney actual immediate press release. And what does it say, Mo?
So revenues for the quarter grew 8%. Let's see if we can dig further here.
Okay. Oh, wow. Look at that. 8% change. 8% Income from continuing operations up 5%.
Yep.
Oh, okay.
Operating income down 7%. Let's see if we can go further here.
Segment results. Ooh, look at that.
Oh, I wonder if we can get into and see what their Disney Plus numbers were.
Oh, I'm sure
that's
they will.
Be huge. Okay. Change Disney Parks. Wow, look at that Parks experience.
21%. Makes sense.
Yeah, it does. Everybody coming back. Now here's Disney Media. That's Parks Entertainment. Let's see.
Direct to consumer. So why don't you look up that stuff? I'll start pulling up Disney on the. So guys, let's pull up our software. And if you're new, again, we're going to talk about things in a different way than most of these other YouTube hypesters talk about. We care about fundamentals. We care about the long term. Everyone says they care about the long term until there are short-term losses. We genuinely want stocks to fall. I will tell you right now, this pisses me off. I wanted them to miss on earnings and miss on revenue. As an example, Tim was writing down the numbers for me. He goes, oh, good for them. They beat on both earnings and revenue. And Mo said, whose team are you on? Whose side are you on? Because Mo and I are rooting for bad results. Not because we want people to suffer. We want to buy stocks at great prices. And you can't buy them at better prices when they're going up. All right? Today was a rough day in the market for most people. The market was up a lot. I added to some short positions. But look at this. Look at the high for Disney. On February, all-time high on March 8th of 2021 hit $203 a share. 52-week low was just a month and a half ago, $84 a share. Keep in mind, I think during COVID, it was higher price than that. Yeah, COVID hit a low of $85.98. So that's pretty interesting. Now, some metrics to look at. The difference between market cap, which is buying all the shares outstanding, versus enterprise value, which means buying the entire company and paying off all the debt, is about $93 billion. Is that good or bad? I don't know. I will say 5-year average free cash flow of 1.85. Now, it's been hurt a lot because if you look at the cash flow, that 1.85 is not a lot. But look at what it was before COVID. Let's see here. Is this yearly? Yeah, 4 quarters. Let's go to 4 quarters. All right, so let's check out their cash flow over the last. So if you look here, 1 billion, 2 billion, 3.6, 1.7, 10, 9, 8, 7. So this is still very low for Disney, okay? They're not back to normal. Now, with that said, look at their revenue. The revenue is back to normal, and in fact, higher.
Higher than normal.
What did they do for the full year of 2022, Mo? What was that reported? No, not there on the press release.
Of revenue?
Yes.
1 second here.
It'll be on there.
Scroll up here.
Or is that the first quarter of the?
They're showing quarterly, yes.
Because that's the first quarter. I think that's the first quarter of their. Yep. Maybe it's the first quarter of the year.
It is the first quarter of the year. Yes.
So, guys, that's a lot of revenue, and to still be generating that same cash flow. I'm not worried about it, but one of the questions I would ask as an investor is, hey guys, you have record revenue. Where the hell is the cash flow? Mm-hmm. You guys made $10 billion in cash flow in the September quarter ending 2018. And in that same year, you guys did $60 billion in revenue. Now we're at $82 billion and we made $1 billion in free cash flow. Where's the money going? So Those are some of the things to think about. Mo, what'd you say about the Disney Plus subscribers?
So Plus subscribers here in the first quarter, Disney Plus was basically flat domestically. But then when you look total Disney, this includes international and everything, that was down 1%. ESPN was up 2%. Hulu was up 2%. But the Disney Plus thing, that's very surprising.
Interesting.
Yeah. This is surprising to me. I mean, it was basically just a flat number.
Go scroll on a little bit. I see that average monthly revenue per paid subscriber. Oh, that's down too.
Yeah.
Oh.
So if you scroll down a little bit more here, it talks about
unfavorable foreign exchange impact.
Yeah. And
all right.
So ESPN paid subscriber increased, revenue per user increased. So that was good. Seems like the ESPN side is kind of carrying things right now.
Okay.
And Hulu.
So guys, let's see what the analyst estimates are saying about Disney. They're expecting $4.18 for this calendar year ending September 2023, and it's expected to go to $9.48 per share in September 2027. Okay, so if you look at the income statement here, per share, quarterly, back in normal times, they made, let's see, net income per share, $3, $5, $7, $8.50. So that's only, according to analysts, they're only getting back to that $8 number here in the next 3 years. That's kind of problematic for me.
Yeah.
Okay. Now, Grant, guys, Disney's a huge moat. The market cap of Disney is $200 billion. To pull a line from Buffett and Munger, if I gave you $200 billion today and said, go compete with Disney, you're going to have a hard time.
Yeah, you're not going to, you're going to have a very difficult time creating something that can
absolutely
beat them.
Yeah. You've got a Mickey Mouse brand for 100 years. You got all these things. Like, it's going to be hard. Now, does that mean you just go out and pay $200 billion for Disney? That's what you're doing when you buy a stock. These things are counterintuitive to what we're told in the media. You love Disney, you love the brand, your kids love it, therefore you buy it. No, it is possible to overpay for a good thing. If that's the first time you've heard that, or that's the first time you remember hearing it and it's clicking with you, you gotta subscribe to the channel. We have over 2,000 videos. We beat this to death. It's called second level thinking as an investor. The first level is, I like that a lot, I should buy it. Second level thinking is, everybody likes that, everybody's gonna buy it, it's probably overpriced, I need to avoid it. The key to good, successful, long-term investing is being different. Everyone in the world would say they're different. If I ask 100 people in a room who here is different than everybody else, every person is gonna raise their hand. And guess what? It's not true. In investing, it's very few. But the good news is, I was in your same shoes years ago. I was the person who said, that's a great company. I'm going to own it because it's going to grow like crazy. Well, it can grow like crazy and still be a bad investment.
Yeah, absolutely.
Intel, Cisco. The biggest loser today in the stock market was...
Lumen?
Yeah, what was the name of the company? It was Luminati, not Luminati.
I think
Lumen Technologies. They're selling for the same price they sold for back in 1988. And this is a company that's revenue is up 60 times since 1988. Their shares are up 10 times since 1988. So really, it's absolutely unbelievable.
Look at that chart.
And guess what? The growth in the company is insane.
Yeah.
They had fiber optic lines. You're telling me in 1988 that wasn't the future? Of course it was the future. And they're selling at the same price from 1988. Because if you overpay, it does not matter. Eventually, in a short run, stocks are a voting machine. In the long run, they're a weighing machine. All right, so what should you pay for Disney? Now, Disney's a company that's on my watch list. Why? Because it's a great brand and I want to own it for the long run. But I got to wait for the right price to own it. Just like everything else in your life. There's something that you bought recently that's... I remember I was talking to somebody recently, not recently, like a few years ago, software developer guy. And he was talking to me, he's like, oh, I saw some of your videos. So like, you don't like buying good things? I'm like, no. I'm like, well, that's not what I do. He goes, well, what is it? I said, well, what's your favorite thing in the world? He goes, cars. I go, okay. What's your favorite car? He said, it's like 1967 Corvette, whatever number. I go, what would you pay for that? He's like, well, I'm cheap. I wouldn't buy that. I'm like, so then he started to be difficult that way. But the whole point is, your house is probably nice. You don't live in the cheapest way possible. You pay for quality. And that's okay. But if your house is perfect for you, you can't pay $10 million for it because you get a better quality item. Same thing with stocks, except for me, the quality's in the cash flow. Mm-hmm. The quality's in the balance sheet. Is the future potential important? Abso-freaking-lutely, but we don't know the future. This can help piece the puzzles together for the future. The stock analyzer tool was used 1.3 million times by our users last year. Why do you laugh at that, Mo?
It's wild.
It's an absurd number.
It is wild.
And it's growing every single month.
Yeah.
And the reason it's important is it allows you to make a low, middle, and high assumption for revenue growth, profit margin, free cash flow margin, PE, free blah, blah, and then put your desired return in. And it'll tell you what price to pay for the stock, not including the balance sheet. And it's according to your assumptions. So Mo, you do a 10-year analysis, I'll do a 20-year.
Okay.
All right, so revenue growth assumptions. Geez, oh, Pete, this is a hard one. All right, profit margin. Let's do that. Okay. So these are all the assumptions that Mo and I are putting in, and they're all guesses, but our goal is to come up with a wide range of pricing to see where the stock compares to that, determine is the stock selling for a reasonable price or not. Now, since I'm going out longer and longer, I can put a lower desired return, a lower one, because going out so far, I'm going to make very low assumptions. Like literally, if Disney just grows with inflation, if Disney's profit margin is on the low side of their historical line, remember the last few years has been a complete fluke in terms of profit margin. So I'm excluding the last few years. Right. Mo, what'd you do for revenue growth?
So revenue, I did 3, 6, and 9.
I did 4, 7, and 10 for.
Now I will say the reason I did 3 again is if you go back to the income statement and you look at the revenue, I mean,
it jumped up big time.
It jumped up big time, so I kind of normalized it. And if they crush it, then maybe 9%. I don't know.
Okay,
but that was my range.
Profit margin
8, 11, and 14.
So I did 6, 10, and 14. And I think yours for the short, I think that's a good number. So,
yeah.
And okay, what'd you do for free cash flow?
Free cash flow, I did 6, 8, and 10.
See, I did 6, 9, and 12. So we both went lower in the cash flow number.
Yes.
PE.
14, 16, 18.
I did 15, 16 and a half, and 18.
I like it. I like yours more. And my return, 10, 12, and 14.
And I did 10, 12, and 14 as well. Now, the reason we went 10, as you get higher in your assumptions, you want a higher margin of safety, but we already beat the crap out of these things. Mo did especially too.
This is abuse. And 3%, I mean, inflation should be higher than 3%.
What's the thing? Guys, this is
according to the Fed, but whatever.
This is like the market return, 10%.
Yeah.
This is essentially what I view my intrinsic value. So I put it here, but remember, I already beat the crap out of it over here. It's unfair for me to put a higher return here. That would be completely unfair. It's up almost 4% now after hours. Hit the analyze button.
Ugh.
Ready?
Yeah.
It's going to be ugly. Oh, wow.
It's not as bad as I thought.
Low price of 45, a high price of 125 to 145, a middle price of 80 to 90. I keep getting back to that 80 to 90 price.
90. Yeah.
It's always
my
80
low
90.
ground, 39 to 52, 87 to 122, and middle ground, 60 to 80.
So, guys.
And I think that 80 to 90 is probably, and it's on your watch list.
And I have my watch list at 80. It doesn't mean I'm buying it at 80. It means I'm probably going to start looking at it deeper and selling puts on it. So, guys, if it's your first time listening to this channel, you're welcome. Congratulations. Subscribe to the channel. And if you like the software, we're running a special. 7 days, $7, everythingmoney.com. Test it out for 7 days for $7. If you don't like it, then get yourself help mentally, because that's crazy. And thanks very much, guys. And talk to you later. Bye.